afternoon. Welcome to Simflash. In light of an increase of audit failures in recent years, we will be discussing and analysing the case of Sunbeam. What may seem like a regular household appliance and outdoor product company waiting to implode itself. Prior to its bankruptcy in 2001, Sunbeam was already experiencing sluggish sales and profits. As an attempt to reverse the poor business outlook, new management was hired in 1996. Albert J. Dunlap, better known as Chainsaw Al, was hired as CEO and chairman of Sunbeam. In his period of office, he executed significant staff and cost cutting, laying off a total of 6,000 staff by discontinuing close to 80% of its products, thus giving rise to the nickname Chainsaw Al. This initiative was perceived as being effective as sales revenue had gone up by 18 million by 1997, with net income reported at 109.4 million and stock prices going up to a high of $52. However, this steep and sudden surge in sales and profit was not without questionable practices. The audit failure of Sunbeam can easily be attributed to three main issues. Firstly, the material misstatement of restructuring comes into play when restructuring costs were wrongfully disclosed as an expense in 1996 instead of splitting it into both 1996 and 1997. This resulted in a non-compliance with GAAP principles. The same was done with regards to advertising costs that was wholly reported in 1996 despite most of the services to be rendered in 1997. Additionally, Sunbeam carried out a falsification of accounts where a manipulation of accounts is done to project a performance level that is optimistic when in actual fact, Sunbeam's accounts were spiraling further. This was done through various initiatives that Siu Ting, my counterpart, will be covering in later part of this segment. Lastly, the auditor's failure to disclose any incidents of fraud led to the ultimate failure of Sunbeam by signing off on the audited report without highlighting any possible or prominent fraudulent reporting practices. Fitri, my other counterpart, will be furthering this discussion with you later. With that, I will be handing over to Sumita to tell you more about the misstatement of restructuring.
Thanks, Hasrina. Myself, Sumita. I would be covering on Sunbeam overstating or understating the restructuring costs that did not comply with GAAP. Sunbeam created a cookie jar reserve of the amount of $35 million at end of 1996 and used this to inflate the income in 1997. Cookie jar technique, which uses unrealistic assumptions to estimate sales, return, loan loss, or warranty costs. These losses are stashed away as they cannot be tied to specific quarter or a year. Companies then allocate these reserves as they deem appropriate for purposes of smoothing out earnings. They dip into the reserve when their earnings are good to take a hit and also use the reserve when the earnings are low to explain away performance issues. As such, shareholders or investors will receive an improper report on the company's well-doing. There was also contingent sales involving premature recognition of revenue during the study period. The accounting for these transactions generally failed to comply with GAAP for recognizing the revenue before the seller had not actually assumed the risk and rewards of ownership. The terms of the sale were modified or other revenue was otherwise not realized and earned. All these reserves were then found out as a fraud and it actually cost the shareholders $25.8 billion lost in market value. Under GAAP revenue recognition principle, companies may not record its revenue until it is realized, and when it is earned, losses must be recognized when their occurrence becomes probable whether or not it has actually occurred. GAAP also have matching principle in which expenses have to be matched with revenues as long as it is reasonable to do so. This principle allows greater evaluation of actual profitability and performance. However, Sunbeam failed to comply with GAAP. Some of the reserve reduced expenses in fiscal 1997. Under GAAP, these restructuring costs should not have been recorded in 1996 because they benefited Sunbeam's future operations. Indeed, at year-end 1997, approximately 16% of Sunbeam's reported 1997 income came from the aggregation of items that Halo had proposed as adjustments in 1996 and 1997. Now, Siu Ching would be further discussing on financial misstatement.
Further to what Sumita has mentioned, that Sunbeam's financial statements improvement were marked by a series of non-compliance with GAAP, incorrect accounting practices will be discussed in this segment. Firstly, Sunbeam embarked on channel stuffing by artificially inflating current sales and earnings by shipping more goods than could normally be ordered. For example, the use of early buy incentive, including offering excessive discounts and other incentives to induce customers to place orders before they could otherwise have done so. This practice was not disclosed, so investors were unaware of lowered margin and future sales could be jeopardized. Furthermore, bill and wholesales began to be used in the second quarter of 1997. If customers could order goods before they needed them, Sunbeam offered to hold the goods in their warehouse until it is needed, whilst bearing all storage, shipment, and insurance expense. Any unsold goods could be returned for full credit, creating an illusion of a rapid turnaround and dramatically boosted the share price, making the company more attractive to potential buyers and boosting the value of Ramlet's management. These improper accounting practices breaches ISA 204.11a, where one or more individuals in the management intentionally uses deception to obtain an unjust or illegal advantage. Secondly, Sunbeam improperly recognized revenue on a purported sale of parts inventory by selling the parts for 11 million to EPI, with a clause to allow EPI walk away in January. The parts were never sold, but profit was posted. The members of Sunbeam management clearly knew of the misstatement yet chose to continue. Thirdly, their improper deletion from Sunbeam's computer system of all product return authorizations in the first quarter of 1998. Although Sunbeam has to honor their agreements, many returns were delayed past the end of the quarter so that the reserve for return appears to be adequate when it was in fact understated and income were overstated. Furthermore, instead of correcting the accounting fraud, Sunbeam's auditor Arthur Anderson issued an unqualified opinion with respect to the company's financial statement for its 1996 fiscal year by proposing an adjustment to reverse expenses but marking it as immaterial. This resulted in a cumulative effect of other improper accounting practices. Next, I'll pass off to Fitri to talk about disclosure.
As previously mentioned, Philip Harlow, an Arthur Anderson partner and auditor of Sunbeam, had passed on the proposed adjustment after incorrectly applying a materiality analysis. A thing to note here is that, in a typical accounting fraud case, the auditors say they were fooled. It is not the same in this case. It is material information for investors if a company is trying to report fraudulent profits regardless of the amount. An auditor who knowingly allows such profits to be reported has failed in his duty. It is clear that Harlow has failed to maintain the fundamental principles of professional ethics of keeping professional behavior, which will be explained as follows. We know, in conducting an audit, an auditor must and may express that the financial statements are presented in conformity with GAAP only when the audit has been performed in accordance with GAAP. He failed to exercise due professional care in performing the audit and preparing the audit report as required by the regulation, and failed to plan and perform audit procedures necessary to have a reasonable basis for its opinion. Harlow failed to obtain sufficient competent evidential matter through inspection, observation, inquiries, and confirmation to afford a reasonable basis for an audit opinion regarding the financial statements under audit. Instead, Harlow authorized a clean bill of health for Sunbeam's books even though he was aware of many of the company's accounting improprieties and disclosure failures. Although Harlow identified a number of audit risks and accounting issues associated with the Sunbeam engagement and should have known these items could have a material impact on the financial statements, he, as an auditor, did not adequately address the company's excessive restructuring and litigation reserves at year-end 1996, failing to perform sufficient audit procedures to determine whether the financial statements were in conformity with GAAP. However, the idea that millions of dollars can be immaterial is a popular one among accountants, and Mr. Harlow may get support from his peers. Accountants from PricewaterhouseCoopers had gone over Sunbeam's books and concluded the original statements were materially accurate, though the analysis was given to the SAC, but it has not been made public. Even so, his lack of care in conducting the 1997 year-end audit allowed management to recognize revenue on sales that did not comport with applicable accounting standards, resulted in the overstatement of the company's income in 1997 and had cost investors billions in stock losses. Fraud is addictive. When you commit a small fraud, you need a bigger fraud to cover it up, and you need a much bigger fraud to cover that up. The process is of no return, and the amount frauded will just snowball as time passes, which explains the failure in Sunbeam today. Thank you for watching the news tonight. We promise to bring you more news next time. Signing off now.